May 6th, 2010, 2:32 p.m. Lower Manhattan. The sun is shining on Wall Street, but inside the New York Stock Exchange, the air is heavy. The humidity of human sweat and overheating servers. The market is already nervous. Riots in Greece are setting Europe on fire. The euro is shaking. Investors are looking at their screens with that specific kind of anxiety that comes before a storm. But nobody looked up at the sky. They were looking at the numbers. And at 2:42 p.m., the numbers stopped making sense. It didn't happen like a normal crash. A normal crash takes days, weeks. Even 1929 took time to bleed out. This was different. This was a free fall. In the span of 300 seconds, the Dow Jones Industrial Average plunged 998.5 points. That is the single largest intraday point drop in the history of the market up to that date. $1 trillion of wealth evaporated, vanished into the ether in the time it takes you to brew a cup of coffee. Traders on the floor stopped shouting. They just stared. Panic usually sounds loud. Absolute terror is silent. They watched blue-chip stocks, the safest companies in the world, behave like penny stocks in a pump-and-dump scheme. Procter & Gamble, a giant of stability, crashed 37% in minutes. Accenture, a global consulting firm, traded at $40 at 2:45 p.m. At 2:47 p.m., it traded for 1 penny, $0.01. Imagine that, a multi-billion-dollar corporation worth less than the gum stuck to your shoe. On the other side, Apple shares spiked to $100,000 per share for a split second. Reality was breaking. The phones lit up. The rumors spread like a virus. It's a terrorist attack, a bomb in Midtown, cyber warfare from Russia. Traders were weeping. Veterans with 30 years of experience were vomiting in trash cans. They thought the financial system, the very engine of the Western world, was physically collapsing. They thought this was the end of capitalism. But there were no bombs. There were no hackers from Moscow. The enemy wasn't outside the gate. The enemy was inside the wires. And it wasn't an army. It was one man. One man in a bedroom 3,000 miles away wearing a tracksuit. To understand how $1 trillion can vanish, you have to understand what the stock market actually is in the 21st century. We like to imagine men in suits making deals. That world is dead. It died in the 90s. Today, the market is a battlefield of algorithms. High-frequency trading, HFT. These are computer programs designed to buy and sell stocks in microseconds. That's 1/1,000,000th of a second. They don't care about the value of a company. They don't care if a company makes cars or cures cancer. They only care about one thing: speed. These machines fight for latency, the time it takes for a signal to travel from Chicago to New York. They bore tunnels through mountains just to shave off 3 milliseconds. In this digital ecosystem, a new type of predator emerged, and a new type of weapon: spoofing. Imagine you were at an auction house. You want to buy a painting, but you want it cheap, so you have your friends stand in the back and scream, "I offer $1 million, $2 million." The sellers panic, or they get excited. The price moves, but right before the auctioneer hits the hammer, your friends vanish. They never intended to buy. They were ghosts. This is illegal in an auction house, but in the digital market, it happens thousands of times per second. It's called layering. You flood the market with fake sell orders. The other robots see this wave of selling, and their logic circuits scream, "Everyone is selling. The price is going to crash. Sell now." So the other robots sell. The price drops, and then the spoofer cancels his fake orders, waits at the bottom, and buys everything at a discount. It is market manipulation at a molecular level. And on May 6, 2010, someone turned the dial on this weapon all the way to maximum. Someone triggered a cascade that the machines couldn't handle. The algorithms saw the sell-off, and they didn't just sell, they shut down. They pulled their liquidity. They went home. When the buyers leave the market, the floor disappears, and the world falls. Who had the power to break Wall Street? Was it Goldman Sachs, a rogue state? Meet Navinder Singh Saral. He lived in Hounslow, a working-class suburb under the flight path of Heathrow Airport. He didn't wear Italian suits. He wore cheap tracksuits. He didn't drive a Ferrari. He drove a beat-up car. He lived with his parents in his childhood bedroom. The room was filled with plush toys and a PlayStation. He loved FIFA, but in the corner of that room, there was a computer setup that was connected directly to the Chicago Mercantile Exchange. Navinder was a savant, likely on the spectrum. He had an obsessive ability to see patterns in the noise. He started trading at a futon in an arcade, but he realized something early on. The game was rigged. He saw the big banks, the HFT firms cutting in line, stealing pennies from everyone else, using their speed. He hated them. He called them parasites, so he decided to beat them at their own game. He hired a programmer to build a custom algorithm, a modified trading bot. He called it the Nav-Trader. Nav wasn't greedy for luxury. He was greedy for points. To him, money was just a high score in a video game. On a good day, he made $200,000. On a great day, millions. He accumulated over $50 million in profit, but he never spent it. He still used coupons at McDonald's. He still lived with mom and dad. To the banks, the market was a business made real. To Nav Saral, the market was a puzzle he had solved. On that fateful day in May 2010, the market was already volatile. Nav saw an opportunity. He turned on his machine. He instructed the software to place thousands of sell orders for E-mini S&P 500 futures, billions of dollars worth of fake pressure. But the code had a special instruction. If the price gets close to my order, cancel it. He was teasing the tigers, but this time the tigers panicked. For 5 years, the flash crash remained a cold case. The SEC and the CFTC published reports blaming complexity at a large trade by a mutual fund in Kansas. They were looking for a whale. They missed the piranha. The regulators didn't have the technology to see what Nav was doing. They were analyzing the ocean with a magnifying glass. But someone was watching, a whistleblower, an analyst who went through the data tick by tick. He noticed a strange, recurring heartbeat in the order book. Orders that appeared and vanished in milliseconds, always at the exact same pressure points. Thousands of them, millions of them, all tracing back to a single IP address. Not a bank tower in Manhattan, but a residential modem in West London. April 2015, Scotland Yard knocks on the door of the Saral residence. Navinder opens it. He's confused, not because he was caught, but because he didn't think he was the bad guy. When the U.S. government requested his extradition, facing 380 years in prison, Navinder's biggest concern wasn't jail. He asked the officers if he could check his positions one last time. He asked if he could have internet access to keep trading. He wasn't a criminal mastermind in a traditional sense. He was a man so lost in the virtual world that the real world, laws, prison, consequences, felt like the simulation. When they checked his accounts, they found the money. Navinder Saral, the man who broke the world economy, had barely touched his fortune. Most of it was lost to bad investments or stolen from fraudsters who preyed on his naivete. Navinder Saral eventually pled guilty. He helped the government understand how the HFT algorithms could be manipulated. He became a resource, not just a prisoner. Because of his cooperation and his condition, he was sentenced to house arrest. He went back to the bedroom. But the question remains, did Nav Saral crash the market? Technically, yes, he lit the match. But who built the pile of dynamite? We did. The banks did. The regulators did. We built a financial system so complex, so fast, and so automated that a single guy playing a video game in London could bring the entire global economy to its knees in 5 minutes. Navinder is gone from the markets now, but the machines, the algorithms, they are still there, faster than ever, smarter than ever, waiting for the next glitch. And next time, 5 minutes might be all we have.